Well, onto the topic of COVID. And so we've been seeing a lot in the press about how COVID-19 is affecting investments in early stage startups, especially in the short term. So we're hoping to kind of get a picture on the short term and long term perspective and the different challenges and opportunities that you're seeing, especially in regards to deal flow. So are the investment deals that you've committed to prior to COVID-19, are they still going through?
Absolutely, yeah. So we completed on a deal last week, which was great for us to have. Obviously, it's a time of significant disruption, but to be able to sort of work on something and get going on something relatively.
Was my internet okay, by the way?
It's perfect.
Cool.
Yeah, no audio
Right.
problems. Dog okay?
The dog is okay. I would, and I've seen, and so for the other companies in our portfolio who are raising money right now and who are far along in those deal processes, fortunately, we've seen other funds carry on through with those processes and not impair either valuations or put in onerous terms or anything like that. Needless to say, bad news also travels fast, so I have heard of some funds pulling out.
How are you prioritizing new deals over the next 3 to 6 months? And like, are you still scouting new investments? What's that landscape looking like?
Yeah, so good question. And obviously, I've been talking to sort of my peer group in the VC world about this over the past couple of weeks, and so there's like a lot of people are talking about like business as usual, open for business or whatever it is. And I think, broadly speaking, that is true. However, like there's some small print beneath it. Obviously, like what's happening right now is a huge amount of disruption and potentially opportunity for some businesses in any given portfolio. And so for a venture capital fund like Forward Partners, where we've got 60 odd portfolio companies, it's there's a big exercise that we need to do to understand which companies might need some bridge financing, which companies are in real trouble, which companies have a real great opportunity for a land grab in front of them, all of that kind of business. And this is all incremental work that we didn't have like a month ago, right? And it's all work that has to be done. And so as a result, what that means is that we're spending more of our time being more focused on our portfolio, which feeds through into ultimately just a higher bar for new investments. So we're meeting entrepreneurs, we want to be investing, we want to be doing all this stuff. Nonetheless, like we've got this big important thing, piece of work to do over the course of the next sort of 3 to 6 months and do more investing amongst the portfolio. And so as a result, the bar which is required for incoming deals, I think for the period that you're talking about, 3 to 6 months, is just going to be a bit higher. And so, I think we will probably do, I don't know, anywhere between sort of 75 to, about 75% of the investing that we were thinking about doing this year. I suspect for other funds, it will be the same, if not less.
Okay. And that kind of leads me on to my next question about bridge rounds. So I've heard some VCs saying that they're stopping new investment and they're only reinvesting into portfolio companies to kind of help them through this time. Is that something that that you're seeing a lot with other VCs?
Yeah, exactly. So this is this issue which I was just talking about, is that I think the vast majority of us are needing to spend a lot of time now, or time that we didn't necessarily think that we were going to spend in January or perhaps even in February, looking at our own portfolio and deploying more money amongst our portfolio, which of course has a knock-on effect to the front end of the business.
Yeah. For startups who are looking to raise either a seed round or a follow-on round, especially like in the spring in the next 4 to 6 weeks, which is especially difficult for everybody, what sort of advice would you offer to them?
Lots of different advice. So for our portfolio, and we've just been talking about bridge rounds. I think that
Hmm.
if it is at all possible to push your fundraising out, to give yourself even just a couple of months, it would be sort of better. Ideally, you'd be fundraising just later on in the year when hopefully things are close to, if not totally back to normal.
Hmm.
Um, and of course, that's the sort of direction of the bridge funding which we're trying to provide to our portfolio, as other investors are, is that we don't want people necessarily raising in times where we know everybody else's bar is higher and it's going to be higher to grab attention with investors.
Yeah.
So as far as that is possible for entrepreneurs, it's that would be a great thing to do. Now, I appreciate, of course, that is a luxury which not everybody can afford, and so
Hmm.
if you need to go out and raise money right now, well, I mean, for a start, it's a new tax year, so angels should be angels have got their EIS allowance,
Yeah.
and it's all good.
Hmm.
So now it's not necessarily a bad time on that regard, but I think you need to be sort of cognizant of the fact that people might well be a bit distracted, so processes might take a little bit longer now than before. I think businesses need to be very, very clear about what their sort of C19 story is.
Okay.
So some businesses, and no doubt some which are raising right now, are benefiting from this. They are, goods, services companies, and or they're telecommunications companies, or
Yeah.
whatever it is. And so they're doing really well. So no real problem there, I suppose. For the rest of businesses who themselves are suffering significantly greater disruption, I think you need to have a C19 story. Like, what did you do? And
Hmm.
this isn't just like I reacted to it quickly by taking a 50% pay cut and furloughing the rest of my workers or whatever it is. It's not just that. It's what else did you do?
Hmm.
So if you have a company which is involved in advanced manufacturing, or is somewhat involved in that, so did you get involved in building respirators, or whatever it is? Like, everyone's going to sort of need some things to ultimately just message to investors that they're a good person to invest in.
And they react
Because
well
somebody
too.
who just sort of throws in the towel, just closes the door for 3 months, and that's that. It's fine, but it's less impressive than the person who says, right, well, I did, like, I kept a tiny bit of the business open to make sure that I helped out in this response over here, and then with my furloughed workers over here, the only thing that they're allowed to do is learning and development and training and stuff. And so we set up this training course, or I sent them all on this remote training course, or whatever it is. So you need to have those kind of exciting things
Yeah.
to keep the signal in the investor's mind that you and your company is right to invest in.
Okay.
And then the final thing is that I think you need to you probably just have a story about sort of how you fit into the recovery and how you fit into the next sort of year and a half's worth of economy, because
Hmm.
businesses are raising typically runway for 12 to 18, maybe slightly more months, and the next 12 to 18 months, like it or not, are going to be a little bit weird, I think.
Yeah.
It's certainly a bit weird right now,
Yes.
and sort of having a narrative about how and why your business fits into this slight weirdness and dislocation for the
Hmm.
next runway, again, like, I think is a super important thing.
Yeah, that makes a lot of sense. And kind of on that note of like the 12 to 18-month runway, because we are anticipating a recession, do you think that should impact the amount that founders are planning to raise?
Um, so again, I think in the near term, so uh, I'd like to think that sort of certainly 9 months out from here, if not 6, things return to normal. I think in the period between now and then, I think it's reasonable to assume that round sizes are going to be a little bit smaller,
Hmm.
valuations are going to be a bit lower, um, and yes, so those plans which you had in your mind in January, you might want to to give a bit of a haircut to ultimately, because whether you're watching Bloomberg or whatever it is, like you can see everything is pulling back, and and that effect spares no man.
And I know we're a bit short on time, so just wrapping up here. So given that a lot of startups are experiencing dips in their valuations, and so I'm assuming that this is potentially impacting the return on portfolio companies as well. So does that change I guess does it make it even more significant on how you're viewing the? So sorry, I just had a Zoom pop up. Is this changing the amount of ROI you're needing from potentially new investments?
Good. That's a really good question. I hadn't really thought about that in particular. And the answer to that's no, not really. So we're long-term investors. I mean, venture capital are just in general. So the valuations, yes. So our valuations will be impaired along with the market, and those that we look to sort of public multiples to help us value those. Obviously, will take significantly more of a hit, but nonetheless, like the economics of a venture capital fund is typically predicated on having a few companies that do extraordinarily well. And those companies will do extraordinarily well and be extremely remunerative in good times and in bad. And bear in mind, like we're investing with a sort of 5 to 10 year time horizon. So and who knows what pandemics might happen in a 5 to 10 year time horizon.
No, don't say that.
Let's just assume that it's fine, and as a result, we don't need to skew to higher ROI opportunities. We're sort of we're fine with our sort of risk bucket as it is.
Okay, that's good to hear. And finally, since I know you're a big proponent of consumer-facing industries, I was actually just reading your blog post earlier that you published recently about why investing in consumer-facing industries is so great, which we'll put in the little bio that goes out to everybody who watches this. But what advice do you have, particularly for founders in these industries that are really impacted by COVID, like restaurant, food tech, travel? What advice would you offer them?
Yeah. So it's a funny one. So consumer categories have it's either feast or famine, right? Like you're either sort of able to carry on delivering your stuff, and your sales have been extremely strong. If you do sort of any kind of decoration or essentials or anything like that, versus other sides of the consumer economy that have been totally shut down. And to be honest with you, I think for those sort of leisure, travel, hospitality type startups, I think it is a very, very tough time. The degree of dislocation requires a little bit of sitting on your hands and a bit of a rethink, because if you want to be out there trying to raise money for a business which is in a market that literally doesn't exist today, I think that's a hard thing for anyone to do, and a very hard thing for any investor to get involved with. Not saying it's impossible, of course. I just think it's very hard. And for those people who are out there who can take advantage, economically at least, of what's going on right now, I think the most important thing there is to make sure that you're being sort of responsible about it, and that everyone's sort of healthy, happy, and safe, right? Because while people might well be buying a lot of art or plants or basic goods or whatever it is, ultimately you've also got a responsibility to the people who are working at your businesses, and who need to be kept safe along with the rest of us too.
Right. Absolutely. Well, thank you so much for joining us, and thanks for taking time out of your day. I know this is going to be really helpful to a lot of founders, so we appreciate it.
Yeah, my pleasure. And sorry for the dog delivery interruption delay.
All good. Thank you. Yes. Fantastic.
Cool.
All right.
Cheers.